that correlation between GDP and the macro data points and China's oil demand has always been problematic. For gasoline, you could have seen it. It was pretty clear, maybe for diesel and manufacturing, but it has been tenuous, and increasingly over the past sort of 5-6 years, those relationships have changed. So that's the first thing I think to bear in mind. But we are on the more constructive side. We have sort of 400 to 450 kbd of oil demand growth year on year.
Hello and welcome to this special episode of Oil Insights. I'm your host, Harry Tchilinguirian, Group Head of Research at Onyx Capital Group, and I have the pleasure today of welcoming Dr. Michal Meidan. Michal is Head of Energy Research for China at the Oxford Institute of Energy Studies, and she's joining us today for a special edition of our podcast to focus on China and delve into what is going on. Before we start the show, please like and subscribe to the podcast. I also invite you to visit Onyx's LinkedIn and YouTube channels for more interesting and exciting content. So China has been under increased scrutiny when it comes to the outlook of the global oil market. In their August monthly oil market report, the OPEC Secretariat seems to have pivoted a little bit towards the International Energy Agency's more conservative outlook for the country's oil demand growth. And more recently, prominent Wall Street banks like Goldman Sachs, Morgan Stanley, have also downgraded their views for oil demand in China. Overall, the increase in China's oil demand in 2024 is now looking somewhere between 200 and 300 kbd on the conservative side, perhaps even less in Onyx's own view, while growth in 2025 is probably going to be a couple hundred kbd as well. Now, the string of economic data out of China is certainly nothing to cheer about. Whether it be the hard data or the soft PMI surveys, both suggest that demand for industrial oil products like diesel will probably continue to struggle this year. At the same time, while well-intentioned, announced policy responses to the economy, both on the monetary and fiscal side, are either deemed insufficient in magnitude or probably face execution hurdles. So question marks are raised relative to the future of the country's crude demand, notably in view of the recent weak July data we got for crude oil imports or refinery runs. On the product side, the idea of substitution away from oil is now motivating downgrades in the outlook of mobility fuels like gasoline, with aggressive EV penetration in the car fleet prime driver. So is China facing a structural change when it comes to mobility that could weaken typical correlations that we see between demand for jet or gasoline and the service sector? The once firmly held consensus of robust demand from the petrochemical sector for Naphtha and propane as drivers of China's overall oil demand growth is also called into question, notably if demand for plastics wobble on weaker industrial production or if exports of manufactured goods were to decelerate. So with Michal, we're going to delve deeper into these topics as the health of China's economic and oil demand growth for the rest of the year are going to be very critical for global oil balances, in particular if OPEC should choose to return barrels to the market in the fourth quarter. Now, let's get started. Michal, I just want to start with the economy. Thank you again for joining us today. And so it appears the Chinese economy is struggling. The Q2 growth numbers were sub 5%. And given what you've seen in terms of the economic data, the other indicators that you're looking at, we're soon going to get a Q3 print. Is it going to look any better in your view? Or, are we going to be stuck here?
Well, first of all, thank you for having me on this podcast. The news has been grim, kind of everywhere you look. I think to date in the first half, retail sales were looking okay, and there were little green shoots of productivity or growth. As you said, PMIs, fixed asset investment, even retail sales are slowing. Some of the industrial, we're looking at some of the industrial products. The government's been talking about the 3 new industries, which have really been a boost for growth. These are electric vehicles, batteries, solar panels that have really offset a lot of the weakness in the real estate sector, which has, of course, been declining. And there seems to be no end to the slowdown in sales, in construction starts. The 3 new industries have slightly offset some of that downturn. And we've seen massive increases in production, again, in lithium-ion batteries and EVs, solar panels, as well as exports. In July, the print for some of those started to slow. We're still seeing year-on-year growth, but slightly slower. So even that seems to be slowing down. Freight, which we all also track and look at because you wonder about sort of e-commerce and changes to that, even that seems to be slowing down a little bit. So really the question is this peak sort of bearishness? Is this peak weakness? Probably not. I mean, we tend to get an uptick in Q3 in the autumn. You get a bit more industrial activity, a bit more infrastructure spend that comes into place. Some of the government policies, fiscal stimulus or monetary stimulus, or monetary efforts, I think stimulus is a big word, start to sort of have an impact in Q3. So we are likely to see perhaps a little bit of improvement in some of the subsectors. But and we'll talk about this a bit more, the messaging from the government is it's all good. We're pretty
Something
confident.
that we're not basically surprised to hear, I suspect. But if we want to get realistic around it, I mean, when we talk about China's GDP and efforts being made at delivering a target growth rate, a growth rate that the government sees as the one suitable to provide the social safety net that the country needs, is 5% still realistic? Is that a figure now that when you think about China's growth over the past years, the economic base has become larger, the economy has matured. So with every emerging market economy that grows very quickly at first off a small base, well, clearly as the economy gets bigger, then achieving 5% growth rates just becomes a little bit harder. And in the current context, maybe that it's even a little bit more harder, considering that the country is hamstrung by various sectors that are not performing, in particular large contributors like the property sector. So 5% above or below, what's your gut feel in terms of will they be able to deliver that 5% in 2024 and maybe even 2025?
Probably we're looking at a lower print. I don't think the data will necessarily reflect that. We've seen if China says China will deliver, and we've had long conversations in the past about the rabbit hole of Chinese data and the extent to which it can be trusted. I mean, we'll take it at face value for now and for our purposes. I think it is likely to come in lower than 5%. And it was quite surprising because for years there's been debate in China about whether the government should stop issuing growth targets. They've been talking for a long time about wanting to focus on qualitative rather than quantitative growth and all these sort of different measures. So, and yet they still choose to issue these very ambitious growth targets, which this year too was a bit of a surprise. I think the growth target is a direction of travel. It's sort of to say, because there are lots of different competing policy priorities and environmental, sort of tackling environmental degradations, clearly one of those, and the net zero push is clearly one of those. And I think what the government is trying to do is send a message that we still need growth, right? To the provinces, to the localities that are all hamstrung financially. It is to say you still need to find drivers of growth for employment mainly, but also we need to generate those revenues in order to be able to accommodate our longer term goals. Now, are they realistic? Probably not. I mean, these growth rates have to come down.
Yeah, it's mechanically even. I mean, you touch on a very interesting point because it's true that China in the recent past has been emphasizing quality of growth, right? And from a policy initiative perspective, it's like changing the composition of growth, getting better growth, whatever that means in terms of Chinese parlance. But that brings me, from a policy perspective to the recent third plenum. And were there any items there that caught your attention? I mean, I know national security was big on the agenda. There was a lot of talk that was on risk control. And I think features that were aimed at boosting consumption seem to be a little bit in short supply. So what was your take out of the third plenum? Was there something there that really struck you as being an initiative that would allow us to recapture that 5% growth target, or at least get us closer to that target?
I mean, I think the one thing that's important to note about plenums is that they're not short-term measures. They're not short-term guidance. That's what we have, the annual, sort of the annual 2 sessions and lots of annual policy meetings that are there to set the guidance for the year. The plenum is really the longer term trajectory for growth. It's about, and historically, I think people were waiting for this plenum because historically it was 1978 when the opening up of China was decided, and it was sort of Zhurongqi again in 2001 when there were lots of very fundamental changes to the economy. So I think a lot of people were waiting for this plenum to see if there would be a fundamental change to the economy. And I think we have a view in the West that China's leaders need to wake up and get it, that what they're doing is not good. It's not sustainable for the Chinese economy because it's still state-oriented, it's still very much state-controlled. There's little room for the private sector, and the Chinese leadership has been clamping down on the private sector, which is the biggest driver of productivity and growth.
So you'd be hoping in the plenum, if they were listening to, let's say, external advice, that the sort of long-term overarching direction of travel would maybe be shifted a little bit. So it's not like we are looking at the plenum as saying, what does that matter for today or tomorrow or next year? Again, something therefore that is not going to help support any kind of shift in expectations for the current year when it comes to the economy, right?
Yes and no, because I think where tomorrow starts today, right? Because if you're looking for changes, and a lot of people have been arguing for more market reforms, and the Chinese themselves in the previous sort of fifth plenum talked about the market playing a decisive role in the economy. So people are waiting for power sector reform and oil price reform, and because oil prices are still set, right, domestically, as are gas prices. All of these things need to get signals today. And if you're thinking about the longer term trajectory and things that Chinese have been saying, forget the Westerners, but Chinese have been talking about the need to spur consumption through the private sector. You would want to see some indication of that in the plenum. And to your point, I think another kind of data or point that raised expectations was that in the initial plenum sort of readout, the government did talk about the weakness in the economy. So people thought, maybe there are going to be some, shorter term measures. But the short answer is no. We got the signal, first of all, that Xi Jinping is large and in charge. And I think that's important because Xi Jinping, his vision, his ideology, very state-centric, little room for the private sector, despite the fact that the government does have various measures to support the private sector. All of that seems to override it. The role of the state means less market reforms. And it means that China, or at least the Chinese current leadership, is quite happy with what they're doing, investments in high tech, the securitization that you mentioned, this kind of these supply side policies that don't give enough, again, even in Chinese observers' eyes, don't give enough room to consumption.
Well, that's exactly it. Because I mean, I recall that, for the past couple of years, and in terms of composition of economic growth in China, China has been wanting to rebalance that growth away from external demand towards domestic consumption. So I was a little bit surprised in terms of them falling short on the consumption side of measures, or at least long-term direction of travel. Now, at the same time, I mean, when we're looking at the Chinese economy, I don't get the sense that the central bank is forcefully coming in with monetary easing. So, I mean, the PBOC has taken measures to reduce key lending rates, including the medium-term lending facility, which is used as a benchmark for lending rates to household and corporates, to reduce the 7-day repo. But all of these seem to be baby steps, and perhaps it's a central bank having to provide some measure of stimulus while at the same time being constrained by whatever the policy around the yuan is, because if you're easing too much, then you may lose control over the narrative of the exchange rate. But in any case, other than the plenum, are there other policy initiatives that you've been hearing about recently that could maybe help China in regaining a little bit of vigor in terms of economic activity?
I think the short answer to that is no. I mean, the PBOC has come out saying, again, we're very confident in what we're doing. Everything is okay. Now, you could say the lady doth protest too much.
Sure.
The central banker does protest too much. And when the Chinese leadership says that everything is fine, or any leadership, I think, says everything is fine and everything is under control, you start to worry a little bit. But they are kind of, and I think the market is expecting, at least in China, is expecting some rate cuts in the second half of the year because more money needs to be injected. I think the other problem is that there is no money in the system, right? The real estate the real estate downturn has impacted local government finances. And that is the heart of China's growth. And without those finances, local governments, I mean, we've been hearing about them limiting pay to kind of government workers, to having to recall like bonuses and things like that. They don't have the money to invest in the social welfare that you would need to spur consumption. So there are a lot of constraints in the system. And I think the plenum, to a great degree, recognizes those constraints. The market keeps talking about a stimulus. There's just no money for a stimulus. There's no appetite, but there's no money.
I think that's a very interesting thing you added. There's no appetite, which is also from the viewpoint of the Chinese consumer or household. It's one thing lowering the cost of money, lowering the cost of borrowing, but you don't have a monetary expansion without a demand for credit. And it seems to me that the Chinese household is just erring on the side of precaution while waiting to see how the economy develops. So you have all this surplus in real estate and households that are just a little bit wary about going out and borrowing now to buy that new home. So you end up with excess capacity. Obviously, these property sector is over leveraged. And then you go, well, if there's no money, and this is one of the key aspects of the economy, then it's pretty hard to see the economy as a whole being able to deliver on these 5% targets, which then, from an oil demand perspective that we're going to talk about, we start thinking about, well, what it is that could actually hold it up. So, I mean, for global, so not global, but for China's oil demand, I mean, if we look at it from a top level point of view, I mean, the IEA's August oil market report is relatively conservative in its year-on-year growth for China's oil demand at circa 300 kbd. The OPEC Secretariat, on the other hand, is seeing growth in the area of 700 kbd. There's obviously a very wide spread in view between these two institutional forecasters, not just for China, as we know, but also for global oil demand. But what is your view? What is the view of the Oxford Institute for Energy Studies in terms of what kind of growth rate we may be able to achieve? Are we going to land somewhere in the middle between those two views, or do you err more on the side of caution or optimism?
We're more on the optimistic side of that spectrum. And I think we have to note, and you noted this in your introductory remarks, that correlation between GDP and the macro data points and China's oil demand has always been problematic. For gasoline, you could have seen it. It was pretty clear, maybe for diesel and manufacturing, but it has been tenuous, and increasingly over the past sort of 5-6 years, those relationships have changed. So that's the first thing I think to bear in mind. But we are on the more constructive side. We have sort of 400 to 450 kbd of oil demand growth year on year.
So still sizable. I mean,
Still sizable, and sort of gradually shrinking and gradually slowing.
So I guess from your point of view, the question is that once you start looking at the conditions for domestic demand, I personally hold a more bearish view in the second half. I think that China has delivered most of its growth. Second half, we'll see. But China's demand for oil products naturally begs the question of, well, China's demand for crude oil. And so whether or not we're going to be seeing the kind of refinery activity in China that is going to generate crude oil imports that people are relying on to support the market. Because if China's not there to buy crude oil, well, of course it is going to continue to buy. But if it remains on the sidelines, then from an oil market perspective, this is going to pose a big challenge to OPEC. So what's your view in terms of China's domestic oil demand for products and what their refinery activity could look like? Are we going to be refining as much oil as people think we are? Because there are a lot of optimistic people out there regarding refinery runs, or is it going to be a little bit more subdued?
I think it's going to be a little bit more subdued, and I'm with you on most of the growth has happened in the first half of the year. So we see less sort of demand growth in the second half, and actually most of that having taken place in the first half. We also need to bear in mind that 2023 was very strong. So we're working off very strong bases for refinery runs, for crude imports. And so inevitably,
So on a
there's the base
year-on-year
effect.
perspective is,
We're likely
but
to
absolute
see.
levels,
But even absolute levels, I think, are shrinking. I mean, when you think about, again, demand weakness, limited export products so far, right? This is an ongoing source of negotiation between the oil majors and the government. For now, I think the government is capping oil product exports and the quotas that it will allocate for those this year, which again gives fewer incentives for the refiners to run. I think the things we need to watch sort of beyond the high frequency data and how much mobility and how much jet, the kind of product by product, bottom up demand on the kind of macro and policy levels for oil is two main things. First is kind of what we've been calling the policy pendulum shifts. Whether the government goes for pro-growth kind of priority, and everything we've just said suggests that no, it won't, unless it's spooked by July-August data. Sort of July data has been weak. If August and September data come in just as weak, we might see a response to try and sort of balance out.
Because I've heard very often that, and you mentioned product export quotas. I've heard very often the argument that sometimes the Chinese government may be inclined to increase these quotas to allow the refiners to keep running. Otherwise, they wouldn't run as much given the weakness in domestic demand. And so obviously, there are two things to bear is that the export margins still have to be good for them to run. But assuming that they're decent enough by affording Chinese refiners extra quotas to export products, you have, in terms of value-added measures to GDP, this sector that continues to run, and maybe that's one way of propping up the numbers. We're saying data issues in China around GDP and how they put it together just a couple of days after the quarter is ended. Well, maybe if you allow the refiners to keep running, then that may help support your Q4 number. So what do you think about that possibility? Because if domestic demand is weak and you want these guys to run, or those who are hoping that China is going to run sufficiently to generate that import of crude oil, well, export quota increases are a solution. Restocking for SPR purposes could be a solution. Do you think that any one of these options is viable?
They're all viable, they're all always on the table, and you add to that the other measure, which is import licenses for independent refiners. That again can be sort of higher or lower, because this is the perennial debate between the Ministry of Commerce and the Ministry of Ecology, sort of Ministry of Environment and Ecology, where the Ministry of Commerce is the one mandating with generating growth and listens to the refiners that say we want more export quotas, or to the independents that say we need import licenses. And the Ministry of Ecology and Environment that says, look,
Obviously
we can't be running this stuff and just keeping the pollution at home and sending the products. And, bear in mind, it's what, 1.5, 1.6 million barrels a day of product exports for a market that's 15 million barrels a day of demand.
Yeah.
So,
we're not talking a couple
nothing.
barrels. No, we're talking obviously substantial amounts. And so that's sort of the big picture in terms of oil demand. You're looking at maybe 400 to 500 kbd. There's a wide spread in terms of Chinese total oil demand. So it'd be interesting now to maybe touch upon the individual products a little bit. So starting with diesel, I fail to see how diesel will have any growth this year in China, given everything we said in terms of the sectors where diesel is most directly impacted. What is your view? Are we, between manufacturing, real estate, so you think about diesel in terms of freight and moving goods around, and heaven forbid, should exports prove weaker, then the impact on manufacturing and obviously having to move these goods from one area to another, all of that, it doesn't really bode well for Chinese diesel demand. What do you think?
It doesn't. We've got diesel sort of flat, not declining.
You're also flat, yeah.
We're flat. Diesel has been a tricky one. I think a few people, including the Chinese majors, have called peak diesel in 2014 and then again in 2019, and yet it seems to have kept growing. One of the issues that we faced mainly with diesel has been product underreporting by the independent refiners. And that is an issue that has stopped in the past few months. There has been tax crackdowns and lots of other sort of crackdowns on the independents, so there's less misreporting and misclassification of products. But diesel has kept growing pretty strongly. But I think I'm with you this year. the real estate crackdown, there's so the real estate slowdown, limited industrial activity, all of that has weighed on diesel. Freight has actually been relatively good. I mean, freight is a very changing picture in China because you've got what we typically think about, all the goods that are moving, but there's also more and more local shopping, but it's not just as we do the kind of Amazon e-commerce and deliveries. You're getting the more affluent provinces starting to import from the neighboring province, something that you didn't have before. You used to, especially after COVID, there was much more freight from your local grocery store, your local store. Now people are sort of moving between provinces, which has given a little bit of an uptick to diesel. However, and this goes back to the policy pendulum of pro-growth, which we're not seeing, what we are seeing is very much policies to move the needle on net zero. And that is fuel switching away from diesel to LNG. And that also depends, of course, on prices, but prices of LNG and diesel have allowed that fuel switching to take place. And you're hearing at the margins about more electrification in freight, in small trucks, not massive trucks, and the things that it doesn't come up in the balances, but you're starting to see it.
So that's just sort of at the cusp of growing then.
Yes, and I think we're probably going to be able to call the peak diesel sort of in around this time.
That area. Well, I mean, moving through the product lineup, I mean, you've touched upon maybe structural changes, and is that something that could affect gasoline demand, for example? I hear a number of people who are changing their view on Chinese gasoline demand. A lot more emphasis, at least in the headlines, around electrification of the vehicle fleet, or at least moving away from traditional, I guess, ICE engines to either hybrid solutions or fully electric. I would have thought personally that if the move was more towards hybrids, you're still going to be consuming gasoline. And in a way, the move towards hybrid is not going to be a brake on gasoline demand. But I've seen people bring forward the idea that the penetration of the EV fleet is quite aggressive now in China, and maybe that's setting gasoline demand on a much lower growth trajectory. Is that something that you think is really happening this year, or is it something, for 2025?
I think peak gasoline is probably 2025. And I'm always stunned by, the EV story has been going on in China for a decade, sort of at least. I mean, plans and started 20 years ago, but EV penetration rates have been increasing. We're at 50% sales of EVs now.
So that's really non-negligible.
It's massive, but it's, in the West, again, I think people have woken up to the EV story in China a year or two ago, especially this year when we're seeing more exports of EVs and sort of everybody's scratching their head and going, how did we miss it? Well, these have been government policies. There's been massive penetration. I think we sort of underestimate China in many ways at our own peril, and we either choose to ignore it, or we go the other way of saying, well, everything's perfect, EV penetration, because there's a central government that builds all this charging infrastructure and mandates everyone to buy EVs, then penetration rates, people were calling peak gasoline sort of 2-3 years ago already. The truth is somewhere in the middle, right? I mean,
As always, but
yeah,
it just seems to me that for people to pay attention, you sort of need to reach a critical mass, and suddenly they go, oh, what's that? So it has been something that I've noticed a lot more in the discourse of various analysts, whether they're from banks or consultancies, putting their finger a little bit more on EVs. And in terms of mobility fuels, well, what can we say about jet? I mean, certainly the jet demand in China has recovered quite strongly, especially as it pertains to basically domestic travel. Maybe still has a little bit more to catch up on in terms of international travel. Is jet still one of those products that's going to feature promptly in the growth of overall Chinese oil demand, in your view?
I think it is. I think sort of long term or sort of post 2025, 2026, it's jet and chemicals that we'll talk about that really drive demand. Jet demand has been increasing, as you've said. There's a lot of domestic travel that's happening. Again, that's a little bit constrained by people's concerns about disposable incomes and how much spending. We're seeing much more of that kind of spending, though, tourism and eating out. Although, again, I'm hearing from Beijing that people are watching a little bit those expenditures as well. Certainly much more of that than housing and consumer goods and the kind of bigger ticket products. So jet travel is recovering. We're seeing the government issue visa waivers for foreigners. So the other thing on the
that new?
policy side, that is, they've started earlier this year, and they're sort of trying to accelerate it and promote it. So it's much easier to travel to China now. You don't have to wait 2 hours at the Chinese consulate, pay over £100 for your one entry visa.
And the interesting thing, I was seeing a headline the other day, now that you mention it, and talking about international long-haul travel, it seems that Chinese airlines are crowding out some of their Western competitors because they have access to Russian airspace. So if I want to visit China and the Chinese government is offering me the possibility of, as a tourist coming over, I would much rather fly from Europe to China on a shorter haul voyage. And for that, that's a Chinese plane that's going to take me there and that's going to bring me back. So perhaps there is some element in terms of, that growth component. We did most of the catch up of COVID on the domestic side. Now we're growing back to what would be a normal trend. But you start thinking about, well, wait a minute, what if business travel to China, tourism travel to China, long haul travel, if China could place its planes as a preferred means of travel, or its airlines as a preferred means of travel, then maybe there's a little bit more to go, right?
Yes, absolutely. I was going to mention those air routes, and that's definitely one measure. And we have to bear in mind that international travel to China is much lower. Flights from the US, especially, are much less frequent than they were pre-COVID. There's a geopolitical element to that, so we'll sort of have to see how the US elections shake up, and there is room for growth. And China, again, has been, as part of these more subtle measures to spur growth, nothing that's in your face and none of the kind of more sexy stimulus talk, but there are measures to try to open up more to the world, to encourage more foreign investments. It's the visas, it's different kind of investment catalogs that they're issuing to, again, to try and encourage foreigners and foreign investment into the country. There are things on the domestic front like sort of trying to make the national market more unified, because there's a lot of protectionism on the local level. So a lot of efficiencies that should help the movement of people, the movement of goods, investments. All of those things will matter and they will make a difference. So if we're thinking about an economic slowdown, it's not going to be dreadful. There are measures that kind of gradually offset or support consumption. They're not in your face, they're not big, and we can't really quantify them. And so business sentiment, which again is very, very negative, international business sentiment is very cautious. People are worried about traveling to China. And that's on security stuff. It's also on the logistics of getting around in China, because it's all cashless and the payment systems.
Well, unless you have WeChat, I suppose, so then maybe that helps you out a little bit. But
you need to have WeChat and a Chinese bank account, because connecting a foreign card to WeChat is not great.
Yeah, both of which are not necessarily the easiest to do. But maybe less facetiously, it seems that, there is room and scope for Jet to keep growing after it has done its recovery post-COVID. The international leg, I guess, between the end of this year and next year. So Jet is still going to be part of the drivers of oil demand growth. And to conclude on the sort of product spectrum, you were mentioning a little earlier the petrochemicals, and that's something I'd really would like to talk a bit more about, because there's been an incredible increase in petrochemical, let's say, capacity. The refineries that have been built in China in recent years have always had a tie into a petrochemical facility. And so the argument goes that, well, when you have this new capacity, you can't just leave it idle. You're going to run it, whether you're going to run it at minimal rates, maybe 60% of capacity, but you're going to run this capacity, which de facto generates demand for either propane or naphtha. So PDH plants are going to be taken in the propane. What rate are they going to be operating? Is naphtha going to be consumed? Again, notwithstanding the the economics between naphtha and propane in the petrochemical sector, but it is something that has been the mainstay of a demand forecast for China. So, irrespective of what you think about diesel and gasoline and jet, there's this large chunk around naphtha and LPG. And my thinking was, well, yeah, you have new capacity. That's fine. You're going to run it. And the question is the demand for the products that are being made, is that demand going to be there if the manufacturing sector, the industrial sector is not doing well? So your need of plastics and other components. While you have new capacity that produces products that lowers margins and the overall operating rate of the industry comes down. So maybe that demand impulse that off the new capacity is not going to be so strong. What's your take on it? Is petrochemical demand in China facing challenges as a result of basically its main consumer being industry itself facing constraints? And maybe to add to that, do we need to look at propane and naphtha quite separately in terms of the product prices and margins when you actually use these as feedstocks in the petchem sector?
Lots of very good questions.
Lots of very good questions. I'm sure lots of great answers too.
The demand isn't there. You're right. I mean, the demand growth is slowing considerably on the real estate sector slowdown. Again, one area of growth is the three new industries. A lot of the chemical producers in China are focusing on the chemical precursors that go into batteries, that go into solar panel coatings. And that's been an area of growth and an area of sort of strategic focus for them. We mustn't forget, though, that China doesn't work on balances, not necessarily work on balances and on. There is, of course, an economic rationale, and producers look at margins, but there is also the competition within the market that has to be taken into account. So I think a number of things. On the demand side, again, we're seeing much slower demand growth, sort of real demand for these products. That's not going to stop these operators from running and these plants from starting up. Overcapacity is the name of the game in Chinese industry, right? We're seeing it in electric vehicles, and obviously in the West, we're very concerned about electric vehicles. And that's, of course, part of the story, right? Because import restrictions on these Chinese goods, that is the main outlet of a lot of economic activity and growth right now. But these export restrictions are going to be a problem. But there is an overcapacity in chemicals. There's a very big overcapacity in base chemicals, less so in the more complex chemicals. But China will keep growing and will keep exporting.
So the price sensitivity is not really, I guess, an argument. Because if I were looking at it saying, well, you have all this new capacity, it has to run because you're not going to leave a plant idle. And if you produce surplus product and it's not being consumed, that drives down the margins and that may force a lower operating rate of the sector as a whole. And therefore, demand for either naphtha or propane should at least be mitigated in terms of the more enthusiastic views that have been put out there initially. But it seems right now that it keeps on going. So as long as it keeps on going, maybe the total demand growth for China is still going to be reliant on this base, this petrochemical base. So whatever you think about the rest of the products, that's there to at least provide an incompressible level of demand growth, to which you then add whatever your assumptions are for the other products. So
I mean, for this year, half of our demand growth comes from chemicals, from LPG and naphtha. And I think that is going to continue. Again, we have to bear in mind that the government's mandate on the chemicals sector has been, and for oil products, they want to be self-sufficient. Chemicals, it was about being self-sufficient. Now it's shifted to become a global chemicals power. So China is going to export and is going to kill margins elsewhere, like we've seen with refined products, because there will be state support for that, be it tax rebates or other kind of soft, the margins in China or sort of operating rates and operating costs in China are highly likely to be lower than elsewhere because you have lower power prices, lower land costs.
We're going to get a geographical shift in terms of overall capacity operating rate. If they don't stop and then they export, then this is obviously going to place a a burden in terms of foreign entities or non-Chinese entities. So the ones that may stop operating are not necessarily the Chinese facilities. They could be the ones in Europe, for example.
Absolutely. I think the Chinese will be the last standing. In terms of those shifts, the other shift that we're seeing, that we're likely to see, the Chinese are integrating, right? They're going, as you were saying, from refineries to petrochemicals. They're integrating much more of the value chain now, going further downstream and further upstream. So we're likely to see less flows of intermediate chemicals from Northeast Asia, from Japan, Korea, much more of the crude flows coming in from the Middle East and the US, much more being produced inside of China, and then the final products being re-exported. So I think that's one thing. And when we think about propane and naphtha, there are different actors in the Chinese market. And so they compete with each other. A lot of the propane goes to the PDH plants. Those are often private PDH plant owners and private companies, whereas the naphtha goes to the state-owned majors that run these
That's a
integrated
very
petchem
different
facilities.
logic, yeah.
Very different logic, very different market dynamics. They compete against each other. We also have coal chemicals in the mix, also
Just to
producing
complicate
products,
that,
just to
just to
complicate matters even more. And you have tens of thousands of small chemical producers in China. Those are the guys in Fujian and Guangdong in southern China that do all of the really creative tax stuff. You probably
That's
remember
a
when we
nice
were
way of
flowing
qualifying it. Yeah, okay.
you remember the mixed aromatic stories
Yes,
that were
yeah.
coming in, and then the tax crackdowns on consumption tax on mixed aromatics. These guys like to mix and dabble and produce things. I mean, there is, and if we go back to the environmental imperative and China wanting to crack down on the inefficient and smaller producers, they are going to crack down on those. And same for refineries. But the big, efficient petrochemical plants that operate in the kind of designated petrochemical bases or that are moved into industrial parks, those will continue to run. So net, you're not going to lose much in terms of the ones that have been shut down, but you are going to get these meaner, leaner petrochemical complexes.
So between state-driven naphtha demand, if I could put it that way, and basically private-driven propane demand and competition between the two, where obviously whenever the pro-nap or propane naphtha spread widens or weakens, and there's obviously a substitution going on in terms of making the chemicals we need or the plastics and so on. But I guess that was a key question for me is there are other sectors than just simply thinking about manufactured goods and plastics or wrappers and you could be pessimistic around economic activity, you could be pessimistic around the real estate sector as reasons to believe that petrochemical demand won't materialize. But as you said, between chemicals required in the EV production process and elsewhere, there are a lot of offsetting segments in the economy that actually do prop up the feedstock demand. And perhaps that's what's going to be China's saving grace this year if all else really weakens by the end of the year. So maybe we get more flattish growth in the second half for the traditional diesel, gasoline, maybe jet. But it seems that what is the mainstay, naphtha, propane, as you're saying, it's half of the demand growth is coming there. That's what's going to really hold up Chinese demand. Interesting proposition for OPEC when it has to make a decision in whether or not it returns, barrels that it has been withholding now for some time. At the end of the day, China is always popping up in the balance equation. So you could talk about the U.S., you could talk about Europe, and you could even look at the health of demand in countries like India, for example. But to some extent, they're relatively self-reliant given their refinery base. And you're like going, well, in that case, what's left? So China seems to be that one element that's really moving the needle on how people think about the end of this year. And as I was saying earlier, OPEC is, well, at least the OPEC Secretariat is at the upper end of the sort of spectrum of forecasts when it comes to China's oil demand growth. And maybe they are also seeing or having faith that petchems will come through to save the day.
And I think, again, they probably will to a certain degree, but there's no doubt that China is slowing. all of these policies and all of these support mechanisms are very much supply side mechanisms. And yes, the government is trying to shore up demand, and it's doing lots of pretty fundamental things to try and support better demand growth, but it is much slower. And this imbalance does start to feed through, especially again when your export market is being constrained and contained. And so I think we are facing an inevitable slowdown, certainly in crude. I mean, it's hard to see how much more they can stockpile. They certainly have 90 days of forward cover, it would seem. So there is, and I guess it's always the balance that needs to be struck with China. The people are either ultra bullish or ultra bearish. No, it's not all doom and gloom. The China story is not done, but it's clearly not what it was. And there are headwinds, but there's still some room for growth, especially as the government keeps its hands very firmly on the levers of the growth story.
Okay. Well, we talked a lot about oil and China's economic activity. We're coming almost to the end of this podcast, and I just want to get your thoughts a little bit on gas. And you mentioned substitution of gas into light freight trucks, and but when we think about gas and therefore either China's LNG requirements or whether gas is going to be taking on a greater importance in the energy mix. What can we say about gas just in comparison to China's baseload coal consumption or the development? I mean China has solar parks that are unending. Does gas have a role in China's energy mix in terms of growth, or are they really relying on coal for the base load, really developing renewables, and maybe gas's role is going to be a little bit more contained compared to other economies that are making the switch. So, what are your thoughts on Chinese gas consumption?
How many hours do we have?
Oh, we've got about 5 minutes.
We'll keep it to 5 minutes. I mean, it's a question of scale and size, right? So Chinese gas demand today is around 400 BCM, and we're seeing a market that's growing at 20 to 30 BCM every year. Not LNG, but gas demand growth. And somebody said that's like a small France every year, right? So it's massive. And yet gas is 10% of China's energy mix. And at the peak, it's probably going to be 13% of China's energy mix. So it's tiny in the China context, but even that transition from 10% to 13, maybe even 15, if we're really optimistic, is anywhere from sort of over the next decade, 150 BCM or 250 BCM growth. So for the international market, of course, it's massive. It's, does China keep the 20-30% growth, 20-30 BCM growth rates per annum, or does it slow? We are on, again, the slightly more optimistic side. We think we're at the kind of 20-25 BCM growth per annum, even though gas is constrained in the Chinese energy mix. The power sector is one, again, where, as you said, gas is sort of caught between coal and renewables. If you look at the Chinese power system, you've got maybe 1,300 gigawatts of installed coal capacity, and we're now looking at close to that of renewables, including hydro, and gas is 126 gigawatts. But you still need it for flex, you still need it for peak shaving. It is still going to be needed to deal with the intermittency of renewables. There are a number of provinces in China that are reliant quite heavily on gas in their fleets. So there will be more growth from that. But the biggest consumer of gas in China is industry. I think it might be a bit like Germany, don't know enough about Europe, but where the biggest consumer of gas is industry. It goes all the way back to all the discussion we've just had about what are the prospects for industry and industrial growth in China. But if you look at the sectors that have been growing, glass, and all of these, the three new industries, steel has been slowing down quite considerably, but non-ferrous metals, glass, those use gas as a feedstock, and those are still growing. And so in the industrial sector, there's room for growth, but it really does hinge on industry and the extent to which China can figure out ways to decarbonize some of those industrial uses. Because it has such a big renewable capacity, it has a potential for green hydrogen as well. So sort of gas is stuck between a rock and a hard place, but there is room for that incremental growth again in power and some industry. in transport. There's been a lot of fuel switching from oil to gas. So all of those little bits in the China context add up to as much as kind of 20 BCM a year.
Sort of thing where when you start seeing gas penetrating, at least trying to compete with oil when it comes to transport, and we're talking about trucks, and brings us back to our diesel story in China, and whether, yes, there's one part of diesel that is driven by economy and the real estate sector. But when you start thinking about trucks and whether these are small trucks or eventually become bigger trucks, you got that kind of penetration that is happening, then maybe the diesel story in China over the next couple of years is not going to be a particularly exciting one. And also leads to conclude that whatever diesel is made in China gets to be exported, and that's not particularly, I guess, favorable in terms of Singapore pricing of diesel cracks, or just simply when it comes to east-west spreads. But that's sort of a longer-term story. But we've reached the end of this podcast. So again, I'd like to thank Dr. Michal Meidan for joining us today and providing her insights on China. So for more on China, I really invite you to visit the Oxford Institute of Energy Studies website. They produce, under the leadership of Michal, the monthly China Energy Report. So very interesting reads every month to keep abreast of what's going on. And with that, I'd like to conclude by asking you to smash that like button, subscribe to our show, and we'll see you again next time. Thank you, Michal.
Thank you so much, Harry.